Millions. I mean, millions of people deal with pain that just won't go away, wounds that seem like they'll never heal, and those super common urinary tract infections,
Yeah.
those UTIs.
Yeah, absolutely.
Not fun.
Nope.
And they're not just annoying, they're actually a huge burden on healthcare systems everywhere, costing billions every year. But imagine if there was a company, a smaller company, that had a unique way of taking all these problems head on.
Mm.
Well, that's where NanoVibronix comes in. Their ticker symbol is NAOV, and they're using something called low-intensity surface acoustic wave technology, or SWOT technology, to do just that.
See, and that's what's so interesting right off the bat. You've got this smaller player stepping into these, really established areas of healthcare with this pretty novel approach.
Yeah.
We've been digging into an investment analysis that takes a value investing approach, specifically looking at NanoVibronix. So what we're going to do in this deep dive is really break down the most important stuff about this company, their technology, their potential as an investment, all through that value lens. We want to give you a clear and concise understanding of what's going on, both in their business and in their financials.
Perfect.
And stick with us, because we're going to wrap up with a really interesting question about how innovation works in the medical device world.
Okay, so NanoVibronix, at its core, is a medical device company, right?
Right.
But what makes them stand out is this patented SAW technology.
Yeah.
It's kind of like, think of these tiny little devices, almost like mini speakers, that make low-frequency, low-intensity sound waves.
Yeah.
The really cool part is they can send these waves through flexible materials.
Exactly.
So it opens up all these possibilities for delivering therapeutic ultrasound in ways that are much more user-friendly and accessible.
Exactly. And that's how they've built out these core product lines. So first you've got Pain Shield.
Okay.
This is a patch, and it's for pain management, and it's already gotten FDA clearance in the US and a CE mark in Europe.
Great.
And it uses ultrasound to treat nerve and soft tissue damage. And the fact that it's made for patients to use at home is a huge plus.
That's great.
Then there's Wound Shield. This is another patch, CE marked, and it's focused on wound healing. So what it does is it enhances the blood flow to the area to help regenerate tissue.
Okay.
It's kind of like gently encouraging the body's natural healing process.
Yeah.
You know?
That's great. You know what I find really interesting, especially given how common they are, is UroShield.
Oh, yeah.
This is a catheter-based device, and it's also CE marked. It's made to prevent those catheter-associated urinary tract infections.
Those CIUT.
Yeah, the CAUTs. It does this by using those low-frequency ultrasound waves, and those waves actually prevent bacteria from sticking to the catheter and forming what's called biofilms. And biofilms are basically these colonies of bacteria that are, like, really hard for antibiotics to get through.
Oh, yeah. It's like they've got their own little force field.
Yeah, exactly.
It's a problem.
It's a huge problem in healthcare.
Yeah,
So UroShield is addressing a really critical issue.
totally. CIUTIs are a big deal. They can lead to longer hospital stays, more illness, and just a lot of extra costs for the healthcare system.
Yeah.
And the way UroShield works, preventing that bacteria from taking hold in the first place, is a really smart way to tackle this problem. They also have NG Shield, another catheter-based product with a CE mark, but we don't have as many details on this one.
Right.
It probably uses that same core SAW technology, but, in a preventative way, like the others.
Okay, so we're looking at a company that, at the moment, is a bit of a smaller player. Our sources show their market cap has bounced around between, like, $1.2 million and $8.3 million. But they've got this really unique technology base, and they've got those important regulatory approvals, especially that FDA clearance for Pain Shield in the U.S. It's also worth noting that the company was founded by Dr. Jonas Zumeris, and the board has a good mix of experience in both healthcare and business.
That's right. And what makes them so interesting is that core value proposition they're offering. Low-cost therapeutic ultrasound delivered through devices that are easy to use, with the potential for more care to happen at home. And the applications for pain relief and infection prevention, those are big markets. But you're right, relying on a small number of products does come with some risk.
Exactly.
If any of those products hit a snag, it could have a pretty big impact on the company.
Yeah, that's a really good point. And even though their patented SAW technology sounds like a big advantage, we have to look at the bigger picture, right?
Of course.
How well can they hold on to that edge when they're up against much larger, more established companies with tons of resources for R&D?
Yeah, for sure.
Okay, so now that we have a good idea of what NanoVibronix does, let's shift gears and look at the people running the show, the management team.
For us value investors, checking out the leadership is key. So let's start with Brian Murphy, the CEO.
Oh, yeah.
He's got over 25 years of experience in medical devices, strong background in sales and operations. But what really pops out is his time at KCI, a wound care company. He apparently played a major role in growing their division from $11 million to a whopping $550 million in annual revenue.
Wow, that's a huge jump.
Yeah, and he also successfully managed the sale of O2 Insights, which focused on wound care diagnostics.
Okay.
His CEO contract's been renewed through August 2025, so it seems like they're pretty confident in his leadership.
That makes sense, given his track record.
Yeah.
What about the rest of the leadership team?
Well, there was Dr. Harold Jacob, a co-founder and the former chief medical officer. He brought expertise in medical device development, had roles at Given Imaging and Oramed,
Okay.
but he resigned after they acquired InView Medical.
Got it.
Then there's Christopher Fashek, the chairman. He's a seasoned healthcare executive, currently CEO of Brain Sentinel, so he's providing that strategic guidance to NanoVibronix.
Okay. And speaking of NView Medical, how has that acquisition changed the board?
Yeah, so the board's actually grown because of that acquisition.
Okay.
We've now got Doran Besser, who is the CEO of InView. He's got a lot of expertise in enteral feeding solutions.
Right.
And we've also got Professor Zeev Rotstein, though we don't have a ton of details on his background. But adding Mr. Besser definitely points to them wanting to branch out into the enteral feeding market.
Interesting.
It's also good to see that the company seems to communicate pretty actively with their investors.
Yeah.
They use their website, SEC filings, even shareholder letters.
That's good.
That kind of transparency is usually a good sign for investors.
Yeah, it definitely shows they're trying to keep everyone in the loop. So overall, it seems like the leadership team has a pretty relevant set of skills and experience, especially Brian Murphy's success in the past.
Definitely. And those new board members from InView could bring a lot of valuable insights as they look to expand.
For sure. All right, let's dive into how they're using their money. How's NanoVibronix allocating capital?
Well, they've been investing in developing and getting their core products out there.
Makes sense.
They just wrapped up the pilot phase of a clinical study for UroShield at the University of Michigan.
Okay.
That's a big step in showing that it actually works. They're also working on next-gen prototypes for both PainShield and UroShield, which tells us they're committed to innovation. And they're going after regulatory approvals and reimbursements in international markets, which is crucial for growth in the long run.
That's smart. And of course, we can't forget the InView Medical Holdings Corp acquisition.
Right.
It was a stock-for-stock deal, and the former InView shareholders now own about 85% of the equity in the combined company.
Yeah.
That's a pretty big change in the ownership structure.
It is. It really shows they're serious about branching out beyond their current products and getting into that enteral feeding market, which is, still in that broader medical device space.
Yeah, definitely.
It shows that management believes there are synergies there and that this could be a big growth opportunity. It's worth mentioning that they don't currently pay cash dividends, and they don't expect to anytime soon.
Okay.
This is pretty normal for companies focused on growth. They need to reinvest those earnings back into R&D, potential acquisitions, things like that.
Makes sense.
So that InView acquisition is a big deal. It's a major bet on future growth and diversifying the company.
All right, we've talked about their business and their leadership's strategic moves. Now let's get to a really important part for any potential investor. How financially healthy is this company?
Absolutely. Let's start with their market cap, which, as we've said, is pretty small and has been up and down. In mid-March 2025, it's around $1.75 million.
Okay.
But we've seen it fluctuate quite a bit.
Right.
A big reason for that and for the lower market cap is the recent 1-for-11 reverse stock split.
Oh, yeah.
Basically, they reduced the number of outstanding shares, which often happens when a company's trying to stay listed on a major exchange like NASDAQ.
Got it.
Yeah.
And when it comes to profitability, their price-to-earnings ratio is negative, which tells us they're not making money right now.
Right.
But we have seen some pretty strong revenue growth at times.
Mm-hmm.
A big jump in the last 12 months, a large increase in 2023, and a notable year-over-year increase in Q2 2024. But then there's also a recent quarter where sales actually went down.
Yeah, it's a bit inconsistent.
Yeah, exactly. And that inconsistency would definitely be something a potential investor would want to investigate further.
Yeah.
Their gross profit margin looks okay, somewhere between 53% and 60%.
Right.
But their operating and net profit margins are negative.
Yeah, their net profit margin has been really low in some reports, which tells us their expenses are bigger than their total revenue right now.
Not great. And then there's debt. Always a key thing to look at.
Absolutely.
The info we have on their debt-to-equity ratio is a bit all over the place. Some reports say it's near zero. Others say it's really high.
Right.
This just shows how important it is to really dig into their official financial statements to get a clear picture of their debt situation. And their cash flow seems to be negative too,
Yeah.
with a big negative free cash flow margin and negative net cash used in operations in 2023. That means more money going out than coming in from their main business.
Exactly. And their price-to-book value ratio has been all over the map, too.
Okay.
A low PB can sometimes mean the market undervalues the company's assets, but it can also mean there are concerns about their future or the quality of those assets.
Yeah, that's a good point. So putting all this together, what's the overall picture?
It looks like a company with some potential for revenue growth, but not profitable yet, with a very small and volatile market cap and a debt situation that needs a closer look.
Yeah, definitely. And when we consider their overall financial stability, that history of up and down and always negative earnings over the long term is definitely a concern for value investors who usually like to see companies with more predictable track record of profitability. And with the company not paying dividends now and no plans to anytime soon, that's something else investors need to think about.
For sure. And those mixed signals about their debt management add another layer of uncertainty.
Yeah, I see that.
Their short-term liquidity seems fine based on their current ratio, but that really high inventory days number, some reports say over 700 days, that's a big red flag.
Yikes.
It could mean problems with sales, bad forecasting, or a messy supply chain. For value investors who are looking for financially solid, predictably profitable companies, those inconsistent earnings and crazy high inventory days are definitely not ideal.
Nope, not at all. We've covered a lot here in this first half, from NanoVibronix's business and management to their financial health. When we come back, we'll look at how the market sees them, who owns the company, and we'll wrap it all up with a SWOT analysis. Stay tuned. And we're back with our deep dive into NanoVibronix. We've looked at the company's fundamentals, so now let's try to understand how the market feels about them. What's the general perception?
Well, it seems like the market is pretty volatile when it comes to NanoVibronix.
Okay. We saw a definite positive reaction in the stock price after that EuroShield study came out, which showed it was really effective at preventing CAUIs. That kind of positive clinical data is a big deal for medical device companies.
Yeah, for sure.
But then the news of the reverse stock split seemed to create some negative feelings, which is pretty typical. It can be seen as a sign that a company is struggling to stay listed on the exchange.
I see.
The ENView acquisition was generally seen as a good strategic move to grow and diversify, though its immediate impact on how the market feels is a bit less clear.
So it sounds like news events are really driving the market's opinion here.
Yeah, it seems that way.
It's also interesting that there isn't a lot of analyst coverage. Our sources suggest there haven't been many recent price targets from analysts, which could mean the bigger investment research firms aren't really paying attention yet.
That's a good point.
Wow.
When we look at the specific news, the EuroShield study from mid-March 2025 did cause a positive reaction.
An 86% reduction in UTIs and a 70% reduction in blocked catheters. That's statistically and clinically significant.
Yeah.
But just a few days before, the announcement of the reverse stock split, which was done to keep them listed on NASDAQ, probably dampened some of that excitement. Reverse stock splits often have a negative image in the market.
I can see why.
The ENView medical acquisition back in February was seen more as a long-term strategic move.
That makes sense. What about short selling? Are a lot of investors betting against the stock?
It doesn't look like it. Short interest seems to be pretty modest, around 4.68%.
Okay.
There was even some talk about a potential short squeeze,
Oh, wow.
which can happen if the price suddenly jumps up, forcing those short sellers to buy back the shares they borrowed,
Right.
which could push the price even higher. We couldn't find much data on options trading for the stock, though. Overall, it looks like the market likes to see real clinical progress, but it tends to be wary of things like reverse stock splits.
I can see why. So let's talk ownership. Who are the main owners of NanoVibronix?
Institutional ownership seems to be between 13.49% and 14.37%. Some of the bigger names mentioned are Armistice Capital, Vanguard Group Inc., and Citadel Advisors LLC.
Okay.
And there's been a slight decrease in institutional holdings recently. Insider ownership, on the other hand, was pretty low before the ENView acquisition, ranging from 0.69% to 8.65%. We didn't see any reports of major insider trading lately.
So before the ENView deal, ownership was pretty spread out. But that acquisition really shook things up, didn't it?
Oh, yeah, for sure. Like we talked about before, those former InView Medical shareholders now control a big chunk, around 85% of the combined company's stock.
Wow, that's a lot.
That's a huge concentration of ownership, and it'll likely have a big impact on the company's future direction. You can usually find details on their corporate governance, like who's on the audit, compensation, and nominating committees on their investor relations website.
Good.
And it's important to remember that the existing stockholders approved that reverse stock split.
Right. So with the former InView team having such a big stake now, it seems like there's a strong alignment of interest there.
Yeah.
And they'll probably have a pretty big influence going forward. It's quite a change from the lower insider ownership NanoVibronix had before, which is something some investors keep a close eye on.
Exactly. Now, to get a good overall view, let's do a SWOT analysis. We'll look at the company's strengths, weaknesses, opportunities, and threats.
Sounds good. Let's start with strengths. What are they doing well?
Well, their proprietary SAW technology is a big strength. It gives them a unique platform. Having FDA clearance for PainShield is a huge advantage in the U.S. market. And the strong clinical validation from the EuroShield study is a big plus. They've also reported revenue growth, which is encouraging. There's potential for cost advantages with their technology. And acquiring InView Medical opens up new market opportunities.
Those are some solid strengths. What about weaknesses? Where do they need to improve?
Well, their consistent history of net losses is a weakness, and their market cap is still very low. They're not as well known as some of the bigger players. They're relying on a small number of core products for revenue, and the pre-acquisition insider ownership was pretty low, and those high inventory days are still a big concern.
Yeah, I see that. What about opportunities? Where could they grow in the future?
The markets they're in, therapeutic, ultrasound, wound care, urinary catheters, are all expected to grow a lot.
Okay.
There's also increasing demand for non-invasive at-home medical solutions, which fits well with some of their products. The positive EuroShield data could lead to more hospitals and clinics using it.
That would be great.
The InView acquisition gives them access to new markets in enteral feeding, and there's always the possibility of partnerships to expand their reach even further.
Those are some promising opportunities. Finally, let's talk threats. What are the potential challenges they might face?
Well, they're up against some tough competition from established medical device companies, and there are always regulatory risks in this industry. It's not certain that their products will be widely adopted, and there's a chance future clinical trials could have negative results. Product liability is another risk they have to manage. They may depend on single suppliers for important components, and they might need to raise more capital, which could dilute existing shares.
I see.
There's also that negative perception from the reverse stock split, and integrating InView Medical will be a big challenge. That reverse stock split, especially, could keep having a negative effect on how the market sees them.
Okay, so let's take a step back and look at NanoVibronix through the lens of value investing. What's the big picture?
It's complicated. There are definitely some good things, like their unique technology, the strong EuroShield clinical data, an experienced management team, and the strategic logic behind buying InView. But there are also big challenges, like their history of not making a profit, their tiny market cap, their past financial performance, and a lot of business and market risks.
So for a value investor, what's the key takeaway?
While there are positive signs and potential for growth, NanoVibronix right now doesn't really fit the classic value investing mold. They're not consistently profitable, and their situation is pretty speculative. Their long-term success depends on becoming profitable, integrating InView well, and getting their products widely accepted in a competitive market.
Yeah.
Investing in them at this stage seems very risky, and anyone thinking about it needs to really understand and consider those risks. Keeping an eye on their progress is going to be super important.
That's a really helpful overview. And it brings us to that interesting question we mentioned at the beginning. In the fast-moving world of medical innovation, how do investors balance the excitement of groundbreaking technology with the need for proven financial stability? And how does early clinical success, like what we see with EuroShield, help bridge that gap for companies like NanoVibronix? It's definitely something to think about as we see more and more innovative but untested companies entering healthcare. Well, thanks for joining us for this deep dive into NanoVibronix. We covered a lot, from their new SAW technology and the promising EuroShield results to the InView acquisition, while also highlighting the financial challenges and risks that need careful consideration.
It was definitely a great example of both the potential and the difficulties of investing in young medical device companies with innovative technologies.
Absolutely. If you found this deep dive helpful and want to explore more analyses of publicly traded companies, be sure to subscribe to the Stock Analytics AI YouTube channel.
And as always, remember that this is just for informational purposes and isn't financial advice.
Right.
Please do your own research and due diligence before making any investment decisions. You can find links to all the sources we used in the description below.
And for those looking for stock suggestions related to this discussion, you can find them in the comments section. Thanks again for tuning in, and keep exploring and thinking critically about the exciting world of medical devices.
Yeah, it's a fascinating space.